Good evening, everybody, and welcome to my weekly webinar, this one on the news trap trading strategy. So the news trap trading strategy is all about capitalizing on market trap situations. My theory is that many of the big moves in the markets tend to occur after a false breakout of some kind. I call these setups market traps. Traps are formed when traders are caught on the wrong side of the market. They typically form after a technical move, but often they have a fundamental trigger, for example, a news move. We have a two-step process called break and retrace. The break move occurs when the market makes a significant move. This can be a chart point break or a news-driven move. Significant moves involve stop orders being triggered as panic buying or selling occurs. If the break move is retraced completely, then a trap is said to have formed and the break traders will be running for cover. Break, retrace, and watch this space. This is the setup from the buy perspective. So effectively what we have is an event where the market either breaks through a support level or a piece of news comes out and the market works sharply lower. We get the break move to the downside. If the move starts to retrace and we go all the way back to the origin point, the point at which the event occurred, then a bull trap is said to have occurred and the market looks like it should be going to the upside. So how do news traps form? News traps formed when a piece of news hits the market and surprises the market and produces a sharp movement as news influence traders react to the new reality. This is the break move. If the news related break fails to see follow through buying or selling, those who bought or sold the break will start to exit their positions and we get a retrace. If all of the break move is retraced, then a trap is said to have formed and we look for a big move in the opposite direction to that of the break. So news traps break down into two categories because news is basically scheduled or unscheduled. So scheduled meaning we know that the news is going to come out ahead of time. For example, economic releases, for example, US non-farm payroll, central bank interest rate meetings and decisions, retail sales numbers, GDP, so on and so forth. Also, we have unscheduled pieces of news. These are not as common. These are things which hit the market without any prior warning. So, for example, an announcement by a leading political figure or a monetary policy figure, or currency intervention, or any piece of geopolitical news which hits the market and causes a sharp, unexpected move. So, with regards to scheduled news, obviously we have as traders, we have an economic calendar. This is one provided by CFI, where we can look at the week ahead and we can see from various countries what economic figures are coming out over the coming few days. So what we have on the calendar, we have a previous number, the last release of the number, a market consensus forecast, and when the number comes out, we get the actual number. So if the actual number deviates significantly from the consensus forecasts, then we have potential for a particularly sharp move. And US non-farm payroll is typically one of the most volatile numbers. So this one, which comes out on the first Friday of every month, is one to keep your eyes on, and we have it coming up tomorrow. Okay, so let's see a few examples of the news trap in action. So a few examples going back a few years. So first one is US non-farm payrolls and euro against the dollar. So in this example, just before the news, the market was 145.5. The news came out better than expected, and the knee-jerk reaction was to sell the euro and to buy the dollar. So you see a pretty sharp move down from the news origin point down to around 144.80, 85. But within the next hour or so, the market started to retrace higher. So we had the break to the downside, and then we had the retrace to the upside. And when we went all the way back up to the red line, the news origin point, all of the sellers are losing money. All of the news-driven sellers are losing money, and a trap has formed which suggests that the market can only go one way from this point onwards, which is up. So in this particular example, what happened for the rest of the day was the market did break above the news origin point, the red line, and then started to trend higher. So there was a good opportunity for the day trader to make money from the long side once we had closed the trap on the bears. Another example here, this is cable, sterling dollar, and retail sales. Just before the number, cable was trading at 149.40, 45, and then the retail sales number out of the UK came in stronger than expectations. So the knee-jerk reaction was to buy the pound and to sell the dollar. So we saw a big spike higher on cable, just briefly broke above that 150 level, and then retraced quite deeply after that test. Then buyers came back in after that pullback, but they couldn't take it to new swing highs, new highs for the day, and then the buying pressure ran out, and then the market then just gave way back down towards the news origin point and settled below the news origin point. So at that point, we know that all of the buyers on or after the release of the news are losing money. They're all underwater in terms of their profit and loss for the day. So that gave us the indication that the market should be going down. So what followed for the rest of the day was the market started to trend lower and closed quite weak, significantly below the news origin point, which would have been the sell trigger for the trading setup. Another example here, this is dollar Canada and Canadian retail sales numbers. Just prior to the release, dollar CAD was trading at 101.60, 65. That was the news origin point. As with the previous example, the retail sales came out much stronger than the market expected, and we saw a gap lower in dollar CAD. So basically, we saw a knee-jerk reaction to sell the US dollar and buy the Canadian dollar. So we had this big gap lower, and then a little bit of sideways movement, and then the market broke down further. So it looked pretty much like the market was heading lower because people were buying the Canadian dollar based on that strong piece of Canadian retail sales news. But what happened over the next couple of hours, again, was that the decline, the move from the news origin point was completely retraced. So we had break to the downside, retraced to the upside. So we've trapped the sellers based on the strong Canadian retail sales. So what happened going into the close of the session, the market basically oscillated around the news origin point. And then into the next session, the market again went sideways in Asia and then started to break higher. And over the next few days, dollar Canada started to trend higher, making higher highs and higher lows. And notice how when the market pulled back, came down, the red line, the news origin point, provided support on the dips. So basically the news-related sellers, short sellers, will be using the dips to exit losing short positions. On to a more extreme example. This is the sterling dollar cable and the UK election, general election result back in December 2019. So in this case, what happened was cable was trading at 130, 175 just before the exit polls came out. So the exit polls came out and they indicated that there's a very, very strong chance that Boris Johnson was going to win a crushing majority and that Brexit was going to get done and so on and so forth. So a certain amount of certainty was coming into the market. So the market literally gapped up from 130, 175, traded above 135, and then started to ease back a little bit over the remainder of the session. So we had this news-related gap higher move based on an unscheduled piece of news. Well, I guess scheduled in the fact that we knew the election was coming, but we didn't really necessarily know what the result was going to be. So over the next few days, the market started to trend lower. And then 2 days afterwards, we went back through the origin point of the news, 130, 175, and that closed the trap on the bulls. The buyers basically were trapped above 130, 175. So that gave an opportunity for the multi-day, if not the multi-week trader, to trade the market from the short side in the knowledge that the news-related buyers were trapped. Another example, again, US non-farm payroll and euro dollar. This time we have euro dollar trading at 130, 175 just before the US non-farm payroll release. The number hit the market and US non-farm payroll fell twice as much as the market had expected. So we saw this massive ramp lower in the dollar, ramp higher in the euro. So euro dollar basically ramped up from 130, 175, 132, 80 or so very quickly, and then rallied a little bit higher above 133, and then saw a little bit of sideways move into the close. So at the close of the Friday of the non-farm payroll release, for the most part, the buyers were happy. They were in the money. But what happened on the Monday was we started to see a retrace lower and a weak close on the Monday. And then on the Tuesday, we broke back down through the news origin point. So again, as with the example with cable, the previous example, we had a situation where we saw a very aggressive news-related move to the upside, completely retraced within a couple of days, presenting a good opportunity to sell the market on a multi-day perspective. Moving a bit more closer in, we have another euro-dollar example with non-farm payrolls. This one where we had euro-dollar trading at 114.03 just before the non-farm payroll release came out, 4th of January 2019. The expectation going into the number was for a rise of 176,000 jobs. But the number came out much better than expected. The economy created 312,000 jobs. So we saw, again, this kind of knee-jerk reaction to buy the dollar and to sell the euro. So euro dollar collapsed instantly from 114.03, 113.70. We saw a bit of a bounce from there. And then from that point onwards, the market started to trend lower going into the European close. But not the end of the story, because shortly after that, we saw a nice short covering rally towards the end of the European session, and the market basically went back above the news origin point, 114.03, and settled around it into the close of the US session, the Friday close. So what we had was quite an aggressive move to the downside based on the stronger than expected non-farm payroll number, but all of the sellers were trapped when the market went back above the red line, which was the news origin point. What I've put down here in green is the average true range, the ATR, which I use as a gauge to tell me whether a move is significant or not. So basically what I'm looking for on a piece of news, after a piece of news, is for a move of at least 50% of the average true range to tell me that we've had a significant move to the upside or the downside. So that tells me, in this case, Eurodollar fell 68.2% of the average true range. So that qualified for a significant move to the downside based on the news which came out. I also like to look for the market to take out the previous session's high or low when a piece of news comes out. And most of the time, if the market is falling at least 50% of the ATR, it tends to do that most of the time. So in this example, again, what happened? So from the Monday, the Eurodollar started to drift a bit higher. And over the session on Monday, Eurodollar started a new uptrend. So in my opinion, that was a lot of the short sellers basically exiting, losing short positions, and maybe putting on long positions because the market basically didn't follow through based on the news. Another example, again, euro dollar and non-farm payroll, this time 6th of December 2019. Just before the number, we have euro dollar trading just below 111, the figure. Again, similar kind of playbook here. Non-farm payroll came out much stronger than market expectations, plus 266 as opposed to plus 187. And euro dollar fell pretty sharply on the news, down to 110.70. Saw a bit of a bounce, but there was no buying pressure, and the market started to trend lower again into the European session close. Again, not the end of the story, because this one took a bit longer to play out. So Monday, the market started to drift a little bit higher, but not aggressively so. Tuesday, we started to see the market actually trend higher. So Tuesday, it rallied up and touched the news origin point, but there was a bit more resistance at that level. And on the Wednesday, the market finally broke through it, and we started to see an aggressive move higher, which again gave the bulls a good opportunity, a good trading opportunity, in the knowledge that we've had a news-related move to the downside, which has caused a trap. Okay, just to briefly pause it there, we have a question. Just 1 second. Okay, could you type your question? Would you like to type your question, or should we leave this one until the end? I'll continue with the presentation. Okay. Okay. Yeah. Please type your question, and I'll come back to it at the very end. Okay. So again, the news-related move prior to this this news trap, euro dollar, the average true range at the time was 37.7 pips, and euro dollar fell from 110.97 to 110.41, which is quite an aggressive move, 140%, 48% of the ATR. So quite an aggressive move to the downside, which eventually got retraced. Okay, moving on. This one's an example with the European Central Bank policy meeting, the interest rate decision and statement about the economy. So this one, the news origin, euro dollar was trading at 108.84 prior to the news. Obviously, with the ECB, it's a double-edged news situation, because typically we have the interest rate decision plus any stimulus or not come out at 1:45 Central European time, and at 2:30 we have the statement, the meeting starts. So we have a couple of opportunities here for the market to start to see a news-driven move. So in this case, we have, there we are. Let me just pause that and answer the question. I can see it. If the trap sellers are bailing out, explain why the price rises. Okay, so what we're talking about is a piece of news comes out which is bearish, and then the market collapses based on the bearish news. So everybody jumps in, sells the market because the news is bad. But what I'm saying is, if the move which we have seen, the selling based on the news, if that move gets completely retraced, then we know that anybody who's sold the market on the news or after the news is losing money, and that gives us the market the impetus to go the other way. Because what happens is, obviously, the sellers who are trapped will be closing their short positions, which are losing money, and that's what creates the bid to drive the market higher. I hope that makes sense. Does that make sense? Okay. Okay. There we go. Okay, perfect. My pleasure. Any more questions, please fire them across, no problem. Okay, so another example, European ECB meeting. Euro dollar was 108.84 before, just before the announcement, and the market started to drift a little bit lower, bounced up a little bit, nothing really major. So that the speech got underway, and then the market started to fall. So it was kind of looking pretty weak going into late Europe over the ECB session. So quite a nice move to the downside. Okay, so again, what we're looking for is the retrace. So we had the break to the downside based on the speech as it was unfolding, and then the market went all the way back up through the news origin point. And that one actually was kind of instant gratification for the buyers, because obviously once we break to the downside, we trace to the upside, we now have a trap which suggests the market should be going higher. In this case, the market went through pretty aggressively as the buyers came in. So quite a nice quick move to the upside. Bit of a profit taking there, and then sideways into the close. Not much going on in Asia the next day, but then as the Europeans came in the next day, the market started to trend higher. So that piece of information again was a good piece of information, which gave you a kind of a bit of a bias, shall we say, based on the fact that we know that a significant number of sellers are trapped based on a piece of news. Okay. Okay, so now just want to show you how one could turn this setup into a trading strategy. This is the buy example. So first things first, obviously, for scheduled news, we're checking our economic calendar. So what's coming up, anything major? I believe that they're color-coded, each of the releases, because on any given day, there are many possible situations, setups, and most of them are they're color-coded so that we know which ones typically can cause a market movement or have done in the past. So we're checking the economic calendar, we're looking at the markets that we trade. Is anything coming out in the country according to the markets that we trade? So for example, if we like to trade dollar Canada, we'll be looking at Canadian economic releases, US economic releases, that kind of thing. Okay, so just before the news comes out, as we know what time it's going to come out, we mark the price on a chart or write it down, so we know what the news origin price is. Then we're waiting for this significant decline after the news. So what we're looking for from a buy setup is we're looking for a piece of bearish news which sees the market decline sharply after that piece of news. So that will set us up to possibly buy the market if we get the trap, only if we get the trap. Okay, so what are we waiting for in terms of significant? We're waiting for a new session low, breaking yesterday's low, for example, and or a 50% ATR move below the news origin price. So that tells us that we've seen a significant move to the downside based upon the news. Okay, so if we get that, then we can get ready to buy. So my strategy is basically to put a buy stop order to enter the market at the news origin price, or just above the news origin price, because we know that if we get to the news origin price, we know that all of the sellers are trapped. We've got ourselves a good buy setup. I say 3 units because typically it's good to try to exit the market in stages rather than buy with one target and one stop loss. I like to buy with a stop loss and maybe 2 or perhaps 3 targets. Okay, so this is kind of the graphical representation of what I'm trying to achieve in terms of trading setup. Okay, so just come through on the chat. Okay, yep, on the live chart. Yep, let me just pop back. Okay. Okay. So let's just pick one at random. Okay, so essentially what I'm doing is I'm saying, okay, we've had our significant break to the downside. Once we've had our significant break to the downside, I'm putting a buy stop just above that red line for 3 units. So that 3 units can be 0.1 lots, or it could be 30 lots, whatever it is. The idea is that the position size has to be divisible by 3 so that we can get out at profit targets along the way. So once the market breaks through the red line, we're long 3 units, whatever that number is. We have a stop loss, which I usually put below the low for the move under here. And then profit targets to exit a third of the position at PT levels along the way. 3 units means if 3 lots, for example. So let's say, for example, I'm going to buy 3 lots. I will sell 1 lot at the first target, another 1 lot at the second target, and another 1 lot at the third target. Yeah. So it's simply, I could be buying 9,000 shares. So I'm looking to buy 9,000 shares, sell 3 at PT1, sell 3 at PT2, and sell the other 3 at PT3. Yeah. So essentially, units means number of contracts or lots or shares or whatever it is, whatever the market that you're trading. So in FX, we're typically talking about lots. Okay. Okay. So essentially what we're doing is we're saying, right, we've had the bearish breakdown, a news-driven breakdown, as we've seen in the examples. So the market breaks down quite sharply based on a piece of bearish news. Once we've had that break, we're not buying it at this point. We're just waiting for the market to get back above this red line. Okay, so that's where we're looking to buy it, only if the market gets back above the red line. And I would say that most of the time the market doesn't, because typically when a piece of bearish news comes out, it usually means that the market, something has changed in the market and the market wants to trend lower. But this setup is for the perhaps rarer occurrences when the market breaks down sharply according to a piece of news, but cannot sustain that break. We get the break and the retrace, and then suddenly we find ourselves back above this red line. So all of these sellers are trapped. All of the sellers below the red line are trapped. So we buy 3 units here. It could be 30,000 shares. It could be 0.3 lots, whatever you're trading. And typically putting a stop loss below the lowest point for the move. Okay. Then knowing where the protection is, because not every one of these is going to be right, we want to know where we're going to get out if the market goes the way we expect it to go. And so I calculate levels to take profits, PT1, PT2, and sometimes PT3, sometimes not PT3. So how is the trade managed? So the market bounces up above the red line, we buy 3 units. We put a stop loss below the low for the swing, the post-news low. So if all goes well and the market continues higher, we hit our first target, PT1. We take profits on 1/3 of the position. We sell 1 lot out. Then we raise our stop loss to our entry point. If the market continues and hits PT2, we'll sell another unit. So we bought 3, we sold 1, we sold another 1, and then we can move the stop up to the PT1 level. So at this point, if the market reverses and comes back down from PT2 to PT1, we get out of the balance of the position, and that's it. That's the end of the trade. If we're really lucky and the market goes as we expect, we hit our 3rd target, and happy days, that's the end of the trade. Let's just go back into the chat again. Okay, so how much time it takes if it drops sharply, it will go up sharply the same way. Time related, I would say that if it happens on the same day, which sometimes it does, sometimes it doesn't, then that tends to be pretty potent, a potent indication for the same day, for a day trade. If it takes a couple of days to go, then that's a little bit different. But obviously, sometimes it depends, I would say, on the distance of the move. So if this move is maybe 200 pips, and then we go all the way back, then we can be looking for quite a big move in the opposite direction. Okay. Okay. Good. I'm glad there are lots of questions this week. Usually we don't get that many questions, so I'm very glad that we're getting questions. Here we go. Okay. Time frame. No, the time frame doesn't matter. In this particular trading strategy, the time frame doesn't matter. So it doesn't matter if you're looking at an hourly chart or a 4-hourly chart. What matters is the news origin point, the price at which the signal is there, and the distance where the stop is and where the PT levels are. So you could be looking at an hourly chart, it could be a 5-minute chart, it really doesn't matter. And what matters is the origin point, the lowest point after the origin, and the targets and the stop loss that get generated. Okay, so you may be wondering where the PT levels come from. So typically I'll base the PT levels on multiples of the size of the stop. So let's say, for example, the stop is, I don't know, 100 pips, then I'll be using multiples of that for PT 1, 2, and 3. So I may use 50 pips as PT1, 100 as PT2, 150 as PT3, or 100 as PT1, 200 as PT2, and so on and so forth. You can leave it to your own discretion, but from my perspective, it's good to have the profit targets related to the size of the risk. Also, one could use a volatility measure such as ATR, average true range. As I say, I like to use ATR in most of my trading strategies and systems because it gives me a good idea as to what market volatility is doing. I also like to use what I call a time-based stop. So get me out of the trade after so many days or so many bars, regardless of whether the trade is in profit or loss. And the reason I do that is because these trades are basically market momentum based. So what we're looking to do is profit from market momentum. And market momentum can turn just very, very quickly. So it's good to get out after a certain push in the direction of the trend. So the idea is to capture some profits as the market moves in your favor and to reduce the risk with the trailing stop. Okay, so how do we trade the news trap sell? So basically, like the buy, but just turn it the other way around. So just before a piece of news comes out, again, we note the price of the market that we want to trade. This is called the news origin price. Then we're looking for a significant rally afterwards based on the news. And this again will involve a new session high and or a 50% ATR move above the news origin price. So once we've got that, we can say we've got a significant move to the upside and we're going to get ready to sell the market if and only if we get back down to the news origin point. We place a sell stop order for 3 units at the news origin point and we wait. This is how the trade is set up in graphical terms. So the news comes out, sharp move higher, people buy the market based on the news, but for whatever reason, the market retraces all the way back down through the news origin point, trapping the buyers. So all of these people are trapped at this point, and that's where we sell our 3 units of the market we're going to trade. We sell our 3 units, we put a stop loss above the high for the move, and we calculate our profit targets for PT1, 2, and 3. And how do we manage the trade? We look to take our initial profit at PT1. So we're short 3 units, we buy 1 back here, we move the stop down from the risk level to the break-even point. So let's say if the market bounces back up from PT1 to our entry point, then we just close the position. So we've just made a small amount of money on the on 1/3 of the position. If the trade continues to go well, we buy back another unit at PT2, and then we lower the stop from our entry point to PT1, and then hopefully we hit PT3 or we get out on the time exit, and then we move on to the next trade. Another question popped up there. Okay, so don't understand what you mean by ATR over 50%. So basically what I'm saying is on every day, if we put up the average true range indicator on a chart, on a daily chart of the market that we're looking at, it will give us a number in pips or points or whatever. So let's say, for example, the ATR for euro dollar is, I don't know, 60 pips. So what we're looking for is a move based on the news of at least 30 pips, because that's 50% of the ATR. Okay, so on every day, we will have an ATR level calculated for the previous 20 days, and that is the volatility measure. So we calculate 50% of that, and when the news comes out, we're looking for the market to move at least half of the ATR above or below the news origin point. And once we've got that move, then we're happy that we've seen a significant move. Because sometimes, obviously, what you can get is maybe the market might move 10 pips or 15 pips or something. And that for me is not a significant move. That's not an important move. Because the whole point of this news trap setup is we want to see that enough people have committed themselves to the market that will give us a good opportunity to trade when they realize they're on the wrong side. Okay, so again, just going back to the short example, hit PT2, we lower the stop to PT1, and hopefully we hit PT3. But if we don't, then we get out on the time-based exit, and then we move on. Okay. So again, just to reiterate, PT levels can be based on multiples of the stop size, and also they can be based on ATR. So you could use 10, 20, 30% of ATR for PT levels. The point is, as long as you keep everything constant and try to keep the risk and the reward related. Okay, so just to summarize on the news trap. So news traps can form at any time. Obviously, we know about scheduled news. We know when scheduled news is going to come out. So we can monitor the economic calendar to see what's coming out, and to monitor it to see if anything, any potential news traps have occurred. Also, for the unscheduled stuff, good to keep an eye on the charts and to see if anything has come out news driven. When the previous president of the US was in power, there were lots of tweets in the middle of the night which caused unscheduled news-related setups on the S&P 500. So literally what you're looking for from the unscheduled side is a sharp move based on a piece of news, maybe some comments from a politician or a policymaker. Yeah, so that's essentially what you're doing. Once a news trap has been completed, they often see follow-through action which can last for several days or several weeks. So as I've shown you in some of these examples, these setups can be pretty good from an intraday perspective, but also they can be quite good from a multi-day perspective. So let's say, for example, you are a fundamental trader, and you want to trade based on a technical event. So you could be waiting for a news trap, which gives you a bit of a technical type of event with a fundamental trigger as well. So news trap can provide a good entry point for the longer term trader based on a really good trading setup, in my opinion. So rather than enter a trade just before a key news release, which can be a bit dangerous sometimes, I'd say the disciplined trader can benefit from waiting for a trap to form before making the trade. And finally, news traps are valid on all markets which react to news events. Many of them do. So it can be quite a good prism through which to analyze a market and to give you a good idea which way the market is likely to go. Because what you're doing when you're trading is you're looking for the path of least resistance. And obviously a news trap will give you a good idea what is the path of least resistance. Okay, so that sums it up. Thank you very much for attending and listening. I'm glad we had a few questions today. Before I go, any more questions before I disappear? If not, very happy to answer any questions via your CFI contact, or if you want to track me down on LinkedIn, I'm on there on a regular basis. I'll be very happy to answer questions that way. Okay, so if there are no further questions, thank you very much. And I look forward to presenting same time next week. Thank you very much for attending. Bye.